Hello everyone. It's important that investors should know about trading and the traders should know about investing. Since stock market is more of an art, the more creative, the more experienced we are, we can formulate our own strategy and that might increase the probability of making money. So like every art in trading also, there are two different basic elements. One is all psychological and the second it's technical. Today in this video, we are not going to focus on the psychological part. It's an another day topic. Rather than we're just going to focus on the technical part. Now in the technical part, we can further divide that into two. One, price action. Two, volume. It's like an alphabet. Like how we formulate new different words using different alphabets. We can formulate our own indicator, our own chart pattern, etc. by fully understanding those two basics. So in my view, let's do the basics correct. I mean, many traders are looking for an easy answer, hoping to find some secret hint that tells them when to buy or sell, so they can simply execute it. But I want to clarify, there is no such secret trick or magic hint in the market. Everything only will give some probable guidance. So what really matters in the market is to understand who is more dominant, the buyers or the sellers, who is more aggressive. To begin understanding this, as I said, we should give more focus on these two things, the change in price and the quantity being traded, otherwise called price action and volume. I keep on repeating this because I want you guys to understand that these two, volume and price action, are the most crucial parts of trading. Now first let's understand what a volume means. Volume refers to the number of transactions in the market. So if you see a volume of 1, it means that one transaction has occurred. One item has been sold. One common misunderstanding about volume is that people think it indicates more buyers or more sellers. But that isn't true. There is no such thing in the stock market as more buyers or more sellers. But what does exist is more aggressive buyers or more aggressive sellers. So when you see a volume of 1, it simply means that there was a buyer and a seller. They agreed on a price and the transaction happened. If we see the volume is listed as 10, it means that 10 contracts, 10 shares or 10 units of whatever the commodity we are dealing with have been traded at certain price. That means 10 units had to be sold by one side and bought by the other, which equates that number 10. Now what we can determine from the volume is, we can determine whether the buying side are more aggressive than the selling side or the selling side are more aggressive than the buyers. Many traders often miss or neglect this aspect of volume. Now to understand who is more dominant, who is more aggressive, is it buyers or the sellers, we use the concept called the auction market theory. Let's consider stock market is like a big auction place. Here we have both buyers and sellers, both of them trying to agree on a fair price. I mean, trying to find an equilibrium in price on every transaction. And that is what in any stock or an index, we may have seen something called the bid and the ask. In the bid and ask system, the way that works is people place orders. It includes small traders to big institutions. When they place orders, they can choose either a market order or a limit order. In the marketplace, we can observe this happening at all levels. I mean, on every price level, we can see the bids, the ask and the every transaction being executed in the real time. Just for those who don't know, a market order means it's an instruction to buy or sell a stock or an index immediately at the current price. A limit order means it's an instruction to buy or sell only at a price specified by the investor. Now, obviously, if someone placing a market order means, then they are being aggressive on either buy or sell side, depending on the direction of their market order. Now, when they place a limit order means, the bid, the price at which someone is willing to pay for an asset, or the ask, the price at which someone is willing to sell the asset, are less aggressive on either the buy or sell side, depending on the direction of their limit order. For example, any financial instrument, let's say a stock price is going higher and higher and the volume is also going higher and higher. That means it indicates that there is a huge interest in buying at those higher levels or at the new level the stock is expected to reach. But consider a different scenario. Imagine the price of the stock is going higher but the volume remains the same or even decreases. This lack of volume suggests there is not much interest in those levels. However, if volume continues to increase alongside the price, it signifies that there is a strong interest in those specific levels. So that's the basic understanding of how volume, which is very important, goes hand in hand with price action. Here there is much more in volume, like order flow and understanding the auction market theory, that how market operates on, etc. Again, those are in-depth details. If you're interested means I'll make a separate video on that. Now let's discuss the second part, which is understanding the price action. To me, price action has always been the most important, as everyone say it's a king. So it's important to pay close attention to what the price is telling. Price action is the movement of a stock or index price plotted over time. It's the basis for all technical analysis of a stock, commodity or any other asset. I mean, different traders use different techniques to evaluate the price action. Some uses chart pattern analysis, and as the regular viewers might know this, I use candlestick to understand it. For example, let's take this 2 1-hour candle and we will try to identify the price action. First 1 hour, the red medium candle with short upper and lower shadow, which implies market opened higher but sellers were aggressive. They are happy with the market price, so offering for the sell. Now in the second 1 hour, green long candle with short upper and lower shadow, which means buyers become aggressive since they found that the market price were very attractive and they want more. Combining that 2 1-hour candle, we got the 2-hour green hammer candle. Now let's see this Nifty chart for whole day, July 12th. Nifty in the morning, buyers were very dominated and aggressive, moved the Nifty's price towards 19,500. But as soon as the 19,500 was reached, then sellers becomes aggressive and they dominates and pushed the Nifty price down. But once it was at 19,400 level, buyers become aggressive and supported the market. So it's very narrow range, but both buyers and sellers try to get them as upper hand. Thus, combining it for the whole day, it forms the green shooting star candle, which indeed shows the strong resistance at 19,500 and strong support at 19,400. So here the story, support and resistance, who dominates where and when, all are called price action. Basically, it's to answer some important questions. What actions is the market showing? What price is the market accepting? In which direction is the market moving? What supply and demand? And what is the support and resistance? The goal is to understand where the power lies, to understand which price the market is comfortable trading at. If the market believes the current share price, stock price, forex rate or whatever is fair, it will trade around those levels. However, there can be times when this fair price changes due to the economic news, announcement from the Federal Reserve, earnings report or any market event, causing an imbalance in aggressive buying and selling. Sometimes we might see eager buyers step in and push the price up. We can visualize and comprehend these actions on charts, which helps us to understand what the market is communicating. Is the market strong? Is it trending? Is there a significant breakout or breakdown? Is the market selling off or is it just a trick? So by combining these two elements, volume and price action, we need to create the trading strategies to develop the playbook and also to gain the deep understanding of the markets. So that's all in this video. I hope you all found this video interesting and useful. Please consider subscribing the channel and liking the video, so it will help me beat the YouTube algorithm and will also motivate me to do more. Please don't make any investment based on this, as I'm not a SEBI registered advisor. I'm doing this for my and viewers' educational purpose only. Thanks for watching.